Is China a big investment opportunity right now, or is it better to keep your hands off from Chinese stock? This year, the market for Chinese companies doesn't look very good. Alibaba crushed by 60% in 5 years. Tencent was about $100 per share 2 years ago. Now we are at $25 per share. NIO, the hyped Chinese car maker, down by 76% despite the rollout to the European market. The list continues endlessly. All these Chinese companies are listed in the United States via a Cayman Island structure. Warren Buffett says, buy when others are fearful, and even Rothschild said a couple of centuries ago, buy when there is blood in the streets. 60 to 80% drawdown in solid businesses is normally a no-brainer. Buy. But there is one caveat here. Political tensions between China and, on the other side, the United States, which potentially could lead to a delisting of Chinese stock. Questions like these got Charlie Munger at the last Berkshire Hathaway annual shareholder meeting in April 2022. Here is the question.
He says, in the past, you've made favorable statements about investing in China, in part based upon valuation metrics. What is your opinion now, and how much weight do you put on the actions of the government in your analysis? Do the recent Communist Party activities in China, including human rights violations, blatant cyber theft from U.S. companies and others, crackdowns on speech from business and media, etc., cause you to change your opinion on investing in China? And how do you evaluate the clear dangers of investing under authoritarian regimes, as recently evidenced by Russian atrocities in Ukraine?
Here is his answer why he bought Chinese companies.
Well, those are good questions, and there's no question about the fact that the government of China has worried the investors from the United States who invest in China more in recent months and years than he did in earlier periods. So there's been some tension, and it's affected the prices of some of the Chinese stocks, particularly internet stocks. Just in the last day or two, the Chinese leader has sort of reversed course on that and said he went too far and he's going to pull way back and so on and so on. So we're having some hopeful signs. But yes, there are more difficulties of dealing with the regime in China than there are in the United States. And it's different. It's a long way away, and they have their own culture and their own loyalties and so on and so on. And the reason that I invested in China is I could get so much better companies at so much lower prices, and I was willing to take a little political risk to get into the better companies at the lower prices. Other people might reach the opposite conclusion, and everybody is more worried about China now than they were 2 or 3 years ago. So that's just the way it is.
Well, Charlie Munger bought Chinese companies already a few years ago. And what does that mean in 2022? In the next clip, you see the opinion from the Shark Tank investor Kevin O'Leary, in which he describes his take on Chinese stock. This clip is from an interview about 7 months ago.
Yeah, Meituan, think of Uber Eats in Asia and China. That's basically what it is. It's growing faster than Uber. Anytime you get an analyst calling stocks, multi-billion-dollar market cap stocks, growing in an economy that's larger than ours, our growth rate is, uninvestable, that's a buy signal. That's what that is. Those stocks were crushed today after being already slaughtered. So they're down another 7 to 9%, the 3 that I just bought today. Now, I'm not sure I'll catch the bottom here, but you have to make a fundamental decision. What's been against China, the headwinds for Chinese stocks, all of them, is the ADR structure. To understand that basically the law's been changed on them. They've got basically 24 months to get their audit act in order, or they're going to get delisted stateside. Now, even if that were to happen, which I think it's not going to happen, they're going to fix this before that does, it doesn't stop the growth rate of these companies. There's, yes, a lot of people in China. So if you're trying to figure out how do I invest in an economy that is probably going to be the world's largest economy in X number of years, look, I know we're competing with them, but that doesn't mean I don't invest in it because I can't get growth like that. And these are the big names there that already have the distribution systems in place. So I'm sort of indexing it that way. Now, you have to hold your nose on vol. You can't put the full position on here because today you may want to start thinking about the 3-day trading rule. To get Alibaba, to get BABA down 7% in 1 hour, that's hard to do. That's a very large market cap stock. So thank you, analyst guy. I appreciate that. But at the end of the day, they're still going to grow. And that's why I bought them.
7 months ago is a very long time. A lot happened in the world. There is still the war between Ukraine and Russia ongoing. There are still tensions between China and the United States. Did Kevin O'Leary change his opinion? Let's get it in the next clip. This clip is about 1 month ago.
Service at the same time. I wanted to ask you about China stocks. Right now, they're looking incredibly cheap. Can you invest right now with all of this regulatory overlay in China to take advantage of these depressed prices?
You know, it's such a great question you're raising here because if you're looking for long-term secular growth, there's no question the Chinese economy over the next 20, 25 years is going to become the largest economy on earth. There's no stopping that and no denying it. And there's an economic war, a technology war, a regulation war going on with the United States. That, too, could be temporary. We've seen this happen in semiconductors where they're no longer allowing certain chipsets to be shipped to China. But frankly, these economies need each other. So to have no allocation to Chinese market makes no sense whatsoever. Again, you've got to stomach volatility. The Chinese consumer is emerging. I own China stocks. I have an index of them, particularly global internet behemoths, large companies like Alibaba and many others that are the reflection of what the American economy's gone through. If you own Amazon, why don't you own Baba? The same idea. The Chinese are using online services the same way. Tencent, others, they're there because that consumer is demanding it. So there's a lot of political issues around owning Chinese stocks, the threat of delisting them, but all of that is noise. To have no allocation to the world's fastest growing economy, yes, I agree it's slowed, but you know long term it's going to be the biggest, is crazy. I mean, that to me makes no sense whatsoever in portfolio management.
What does that mean now? Kevin O'Leary has a point here. The Chinese market is the biggest market in the world. Having no exposure in a portfolio to the Chinese market with stock prices beaten down throughout 2022 doesn't make any sense. But there are still certain risks on the market. The US government might decide to delist Chinese stock or the other way around. The Chinese government might prohibit Chinese companies to have a listing in the United States. An article in Barron's from December 2021 has outlined 3 possible outcomes to that scenario. So number one, when Chinese stocks get delisted, according to Barron's, the most logical next step would be that the company buys back all shares from their public investors. Basically, it would mean, say, a similar scenario to what happened to Twitter a few days ago when Elon Musk completed the deal. The company went private again. A second scenario in Barron's was in a share transfer scenario, investors would swap their ADRs for the Chinese company's foreign stock. For example, in the case of Didi, which doesn't have a secondary listing, would need to first launch a listing in Hong Kong or Shanghai, for instance, to establish both a home for its foreign stock and mechanisms for the transfer of ADRs. The third scenario, also with the example of Didi in Barron's from December 2021, if Didi doesn't buy back the shares, but rather delists and doesn't launch another listing, the ability to trade its shares would be in limbo. Investors would still own equity in the company, but they would be unable to trade their stocks on regulated exchanges. They, however, could sell their shares in over-the-counter markets with the downside of limited liquidity. or hold on to them until another solution appears on the market. China might be a big opportunity, but it comes with a risk. Everybody needs to decide for themselves what to do. Go in like Kevin O'Leary or stay away like other investors currently do. Enjoy your day.